What's going on, everybody? What's going on? Welcome back to another episode of the Trade for Yourself podcast. This is the first time that I have went live in a long time. It's been a minute since I went live, but this is a great opportunity to go live because we're going to be able to talk about some of the things that are affecting the stock market right now. And so I'm glad to be able to do that. I'm glad to be able to tap in with you all. Appreciate you all for tapping into another episode as always. Please like, please subscribe. I'm gonna let everybody get in and let's just go ahead and get right into it. Let's start it. Welcome back to another episode of the Trade for Yourself podcast, where my mission here is very simple. I just want to help you learn how to trade and invest in the stock market for yourself. So make sure you please like this, please subscribe. Make sure you hit that notification bell so you can be in the know every single time I drop an episode. I may be going live more. We're switching some things up a little bit. So I appreciate you all for tapping into another episode. So, in this episode, we're going to be talking about how the stock market is concerned about inflation. The Consumer Price Index, CPI, rose higher than what analysts had anticipated in terms of expectations for inflation. Now, that's going to affect the way that the Federal Reserve is viewing inflation and the way the Federal Reserve is talking about interest rates. So, let me share my screen. Three to four main things I wanted to discuss tonight. I want to go over the inflation data. I want to go over the Federal Reserve minutes from their last meeting. And I want to talk a little bit about what that means and then go into the charts because I believe that there may be some opportunities out there that we may need to pay attention to in terms of what's going on in the stock market. All right. So let me get ready to share my screen with you all here. I am going to share my screen with you all here. Okay, so this is a CNBC article. It's a pretty good article. And this article right here is referring to the hot inflation data pushes the market's rate cut expectations to September. Now, why is that? So let's go ahead and go through the article. As recently as January, investors had high hopes that the Federal Reserve was about to embark on a rate cutting campaign that will reverse some of the most aggressive policy tightening in decades. 3 months of inflation data have brought those expectations back down to earth. March's Consumer Price Index report Wednesday helped verify worries that inflation is proving stickier than thought, giving credence to caution from Fed policymakers and finally dashing the market hopes that the central bank would be approving as many as 7 rate cuts this year. The math suggests it's going to be hard near term to get inflation down to the Fed's target, said Liz Ann Saunders, chief investment strategist at Charles Schwab. Not to mention, you've put a pin in inflation getting to the Fed's target, but it's not happening imminently. There was little good news to come out of the Labor Department CPI report. Both the all items and ex food and energy readings were higher than the market consensus on both a monthly basis and annual basis, putting the rate well above the Fed's target. Headline CPI rose 0.4% on the month and 3.5% from a year ago, ahead of the central bank's 2% goal. Now, the one thing that we need to understand about this situation is that the market, we've been hitting several all-time highs this year, and we've been hitting those all-time highs because of a narrative. The narrative about the economy getting better, the narrative about the Fed cutting interest rates, things of that nature. If the Fed does not cut interest rates and inflation is actually going up and going higher than what we anticipate, it may cause the Fed to not only not raise interest rates, but actually, reverse course and actually start raising interest rates again. I personally don't believe that will happen. I believe that the Fed just may keep rates where they are for longer than what we believe, and the market may just have to adjust based on certain things that we see in inflation. Now, there's danger beneath the surface based on what they're saying in this article. Now, the services prices, excluding energy, jumped 0.5% and were up 5.4% from a year ago. A relatively new computation the markets are following, which takes core services and subtracts out housing. It has become known as supercore and is watched closely by the Fed, surged at an annualized pace of 7.2% and rose 8.2% on a 3-month annualized basis. And so the one thing that we need to understand is that housing has always been a sticky piece towards inflation. It's always been sticky. And so they're trying to rewrite things, right? They're trying to recreate these things and try to figure out different ways to observe the data. And that's what we're talking about when we're talking about this super core, to try to give the Fed a better reading on what's actually going on and what prices are actually increasing significantly. Now, there's also another risk in that base effects or comparisons to previous periods will make inflation look even worse, as energy prices in particular are rising after falling around the same time last year. All of that leaves the Fed in a holding position, and the markets are worried about the possibility of no rate cuts at all this year. The CME Group's Fed Watch tool, and this is a very, very good watch tool, and this computes the rate probabilities, the rate cut probabilities as indicated by futures market pricing, moved dramatically following the CPI release. Traders now see just a slim chance of a cut at the June meeting, which previously had been favored. They have also pushed out the first reduction to September and now only expect 2 cuts by the end of the year. Traders even priced in the 2% probability of no cuts in 2024. Today's disappointing CPI report makes the Fed's job more difficult, said Philip Newhart, Director of Market and Economic Research at First Citizens Bank Wealth. The data does not completely remove the possibility of Fed action this year, but it certainly lessens the chances the Fed is cutting the overnight rate in the next couple of months. Now, there was a big deal earlier this year when the Fed decided not to cut rates in March. That was actually a big deal. But the market largely shook that off, and the market continued to move higher, and we continued to reach another all-time high. But now we're talking about the possibility that we may not even get a cut in June, and it could be to September. The question is going to become in terms of, okay, what's going to keep the market going higher? And I'm going to answer that question in a bit, but that's something that you need to ponder on. What's going to keep the market going higher? And so when we look at market reaction, the markets, of course, they didn't like the CPI news, and they sold off aggressively Wednesday morning. The Dow dropped more than 1%. Treasury yields burst higher. The 2-year note, which is especially sensitive to Fed rate moves, jumped to 4.93%, an increase of nearly 0.2 percentage points. Now, this is a big deal because the 2-year note was actually above 5% for a period of time, and now we're getting to a point where we're getting back to that 5% rate. So that's something that we need to pay attention to, because that short-term interest is what we're talking about there. Now, there could yet be good news ahead for inflation. Factors such as rising productivity and industrial capacity, along with slower money creation and easing wages, could take the pressure off somewhat, according to Joseph Laborga, chief economist at SMBC Nikko Securities. However, inflation will remain higher than what is necessary to warrant Fed easing, he added. In this regard, Fed cuts will be pushed out into the second half of the year and are likely to fall only 50 basis points, with risks being tilted in the direction of even less easing. In some respects, the market has only itself to blame. The pricing in of 7 rate cuts earlier this year was completely at odds with indications from Fed officials. However, when policymakers in December raised their dot plot indicator to 3 cuts from 2 projected in September, it set off a Wall Street frenzy. The market was just way over its skis in that assumption that made no sense based on the data, Schwab Saunders said. Still, she thinks if the economy stays strong, GDP is projected to grow at a 2.5% rate in the first quarter. According to the Atlanta Fed, the knee-jerk reaction to Wednesday's data could pass. If the economy hangs in there, I think the market is, for the most part, okay, Saunders said. Now, there's something very important for us to pretty much understand, right? if the Fed is pushing out when they're going to make that first cut and when they're going to begin easing on interest rates, we have to see what is going to be the narrative moving the market, because there's always going to be narratives moving the market. And she said that if the economy hangs in there, she believes that the market for the most time will be okay, right? I will also add in, if earnings hang in there, the market will be okay. So we're getting ready to go into an earnings season, right? Friday, we're going to be getting earnings from JP Morgan and many of the big banks in America, right? So we're going to see what the banks are talking about. The banks always start things off in the beginning of the earnings season. We had Delta report earnings this morning. They had great earnings. TSM, Taiwan Semiconductor, they're going to be reporting earnings next week. So we're having many earnings reports starting to come out here over the next couple of weeks. And if those earnings reports continue to stay in there and we continue to get good news on that front, the market's going to be okay, and the market may continue to keep chugging along. But if those earnings continue to come down and we have inflation go up and those expectations move out, the market may not move the way that we want it to move. But at the end of the day, we have to be prepared no matter what. We got to be prepared no matter what, and we got to pay attention. We got to pay attention and look for opportunities, because opportunities are always going to be there. We should always be finding opportunities to buy stocks. We should always be investing every single month, finding opportunities to buy stocks, because that's very, very important for us to understand. Now, the next thing I want to talk about is I want to talk about the Fed minutes, right? So the Fed wants more confidence that inflation is moving toward the 2% target the meeting minutes anticipate. Now, the federal officials at their March meeting expressed concern that inflation wasn't moving lower quickly enough, though they still expected to cut interest rates at some point this year. At a meeting in which the Federal Open Market Committee again voted to hold short-term borrowing rates steady, policymakers also showed misgivings that inflation, while easing, wasn't doing so in a convincing enough fashion. The Fed currently targets its benchmark rate between 5.25% and 5.5%. Now, the last Fed meeting happened in March. A month after the Fed meeting, they always release the minutes from that meeting to see what were they saying in the room. What information or can we be able to glean from that? And so this is what we're talking about whenever we talk about, okay, what did the Fed minutes actually say? Okay, so let's continue to go on through. As such, FOMC members voted to keep language in the post-meeting statement that they wouldn't be cutting rates until they gained greater confidence that inflation was on a steady path back to the central bank's 2% annual target rate. Now, participants generally noted their uncertainty about the persistence of high inflation and expressed the view that recent data had not increased their confidence that inflation was moving sustainably down to 2%, the minute said. In what apparently was a lengthy discussion about inflation at the meeting, officials said geopolitical turmoil and rising energy prices remain risks that could push inflation higher. They also cited the potential that looser policy could add to price pressures. On the downside, they cited a more balanced labor market, enhanced technology, along with economic weakness in China and a deteriorating commercial real estate market. Okay. They also discussed higher than expected inflation readings in January and February. Chair Jerome Powell said it's possible the 2 months readings were caused by seasonal issues, though he added it's hard to tell at this point. There were members at the meeting who disagreed. Some participants noted that the recent increases in inflation had been relatively broad-based and therefore should not be discounted as merely statistical aberrations, the minute stated. That part of the discussion was partly relevant considering the release came the day that the Fed received more bad news on inflation. So, Jerome Powell said that the first 2 months, January and February, may have just been anomalies due to seasonal trends. Well, March is another month. So now we got 3 months, right? That the Fed's talking, that the Fed has seen, and at this point, for the first 3 months, we've been through the entire quarter. The entire quarter was hot. So we can't necessarily say that, oh, it was seasonal. If January was just seasonal, February that was okay, and then we came back down in March, that's cool. But we're seeing higher inflation than what the Fed has been expecting, and we can't just deem it as seasonal. And that's just what's very, very important. Now, CPI validates their concern. The Consumer Price Index, a popular inflation gauge, though not the one the Fed most closely focuses on, showed a 12-month rate of 3.5%. That was above both the market expectations and represented an increase of 0.3 percentage points from February, giving a rise to the idea that hot readings to the start of the year may not have been an aberration. Now, this is what I want you to understand. This is not the inflation measure that the Fed watches the most in terms of closely. The measure that the Fed watches closely, the most is PCE, the Personal Consumptions Expenditures Index. Now we're going to be getting that information coming out towards the end of the month as well. And so that's going to be another inflation reading that we have to pay attention to. Tomorrow we're going to get PPI, the Producer Price Index. So there's still more inflation information that we need to get, but seeing this particular reading is not necessarily something that we need to see, given what the Fed can and will do when they tend to get fearful about inflation. Now, following the CPI release, the traders in the Fed funds futures market recalibrated their expectations. The market pricing now implies the first cut to come in September for a total of just 2 this year. Previous to the release, the odds were in favor of the first reduction coming in June, with 3 total in line with the dot plot projections released after the March meeting. This refers to the last article we were looking at before. The discussion at the meeting indicated that almost all participants judged that it would be appropriate to move policy to a less restrictive stance at some point this year if the economy evolved broadly as they expected. That goes back to what Liz Ann Saunders was saying, that as long as the economy is okay, then the market will probably be okay, the minute said. In support of this view, they noted that the disinflation process was continuing along a path that was generally expected to be somewhat uneven. So they expected to be uneven. They know it won't be a straight line. In other action at the meeting, officials discussed the possibility of ending the balance sheet reduction. The Fed has shaved about $1.5 trillion of its holdings of treasuries and market-backed securities by allowing up to $95 billion in proceeds from maturing bonds to roll off each month rather than reinvesting them. There were no decisions made or indications about the easing of what has been known as quantitative tightening will happen, though the minutes said the roll-off would be cut by roughly half from its current pace, and the process should start fairly soon. Most market economists expect the process to begin in the next month or two. The minutes noted that the members believe a cautious approach should be taken. Now, these last couple of paragraphs are very, very important in terms of what the Fed does in their role. Now, quantitative easing is described as when the Fed is lowering interest rates and buying back bonds, right? Buying back bonds and injecting money into the economy. Quantitative tightening is when the Fed is raising interest rates and they're rolling off those bonds. They're rolling off those bonds and not reinvesting them, not allowing that reinvigoration into the economy. And they've been doing this over the last 2 years. Now they're talking about this may be the time to where they pause that and they may restart some things, right? That's something that we need to pay attention to, because that could be considered quantitative easing if they restart the process of keeping those bonds on the balance sheet and adding more to the balance sheet. That's something that we really truly need to pay attention to, because that may actually move in concert with them lowering rates towards the end of the year. So again, keep paying attention to what they're doing from a quantitative tightening standpoint, because that may be something that we need to pay attention to at the end of the day, right? Because, you know, the Fed talks about many things, and the Fed pundits and the Fed members, they're always talking. They're always, being interviewed on CNBC. They're always attending conferences. They're always talking about all these different things, and the market's always reacting as a result. And so the one thing that a lot of people aren't talking about is that quantitative tightening in those bonds, right? We need to pay attention to that because it may affect how the market is reacting and how the market views many things. So before I get out of here, I want to talk about the charts. I want to look at the charts. I want us to take advantage of the opportunity that we have here today to talk about some charts and to really, put some things into perspective in terms of some opportunities that we may have out here in the market, and just kind of look at, okay, how has the market been performing and what is it doing? Because I really haven't really dug deep into technicals with you guys in a while. So right now, I've got a chart of the S&P 500. This is a daily chart of the S&P 500, and I've got some lines here, and these lines are representing moving averages, right? So this blue line is the 50-day moving average. This orange line is the 100-day moving average. This gold line is the 200-day moving average. When you see the 100 above the 200 and the 50 above the 100, this is telling you that the particular stock is upward trending, right? It's upward trending. And as long as the stock is continuing to move in that way, we are in an uptrend. And the S&P 500 is clearly in an uptrend, right? We may have pulled back some today, but we are clearly in an uptrend. But we need to pay attention to how the market moves over the next couple of days, because from a long-term perspective, buying the S&P 500 every two weeks in your 401k, that's something that you need to be doing. Every month in your brokerage account, Roth IRA, whatever you're talking about, that's something that you need to be doing, because we need to be dollar cost averaging into the market. But from a trading perspective, we want to be a little bit more careful, right? Because we want to be a little bit more precise, because we could see SPY come down to this area of 508.64, this 50-day moving average. It could come down here and bounce off. There seems to be a little bit of support and resistance here that could cause that to hold, but it could continue to come down a little further. Now, if the market really starts to get fearful, if the market really starts to get fearful and we really start to see, some changes, and we really start to see the narrative shifting, there's a gap right here on SPY. There's a gap right here on SPY between 503.02 and 497.37. So about a $5 gap, right, between these particular levels. Now, if SPY continues to retreat more, SPY could come down and fill that gap and come down below that $500 level on SPY and fill that gap. Now, if SPY were to come down and fill that gap, that would be an area where I believe we really need to go long, right? We need to go long. We need to be making some investments right here, because I'm gonna look at this real quick and just check this out on a trend line perspective. Right now, the market is down about 2.5% from the high, around the all-time high. The market is around 2.5% down from the all-time high. If SPY came down and closed that gap, that represents about a 5% decrease in SPY, and that's the first time we've really had a 5% decrease in SPY in a long time. We definitely haven't had a 5% decrease this year, but on average, 90 to 95% of the time, we tend to have a 5% decrease in SPY. 95% of the time, at least one time throughout the year. We don't know when that will happen, but that's a possibility for us. So we need to look into that. SPY still looks good from a trading perspective. It still looks good long term, but we need to pay attention to what's going on from a technical perspective and take advantage of that. Now, let's look at QQQ, right? I want to take a look at QQQ real quick. So QQQ, QQQ is doing well. It's another stock. It is another stock that is upward moving, but QQQ has actually slowed down. QQQ has actually slowed down some in relation to SPY. QQQ has actually slowed down some. We hit that high back in March, March 21st, but we haven't made that high since then. And we've kind of been on a consolidating, a little bit. We're hovering around that 50-day moving average, but still from a trading perspective, we're looking good. 50 above 100, 100 above 200. This is what we like to see. Technology will probably take the brunt of what's going on when we're talking about a decrease in the market based on what the Fed is talking about. Again, there's another gap here that could be filled if we get a situation to where, we have another situation to where another gap could get filled. Another gap could get filled right here between this 433 and this 425, right? This is a gap. Stock gapped up. We've been holding support right here. This support could get broken. It's a possibility, and we need to pay attention to that. Again, if a closure of this gap were to happen, this will be a perfect area right here to go long. Because we are obviously still in an uptrend, and this will be a good opportunity for us to go long. But we've got to pay attention to what's going on and just look at the opportunities to be able to go long on certain names. Let's look at another stock, AMD. Ticker symbol AMD, Advanced Micro Devices, semiconductor company. AMD is not looking good from a trading perspective, guys. It is not looking good. AMD is not looking good right now from a trading perspective. Now, don't get me wrong. AMD is still a great company. AMD is still been doing its thing. It's still going to, be able to take advantage of the AI opportunities long term. But if we look at how this stock is moving, we look at hit as high as 227.30, back over a month ago. And now we've broken below the 50-day moving average, and now we're hovering around the 100-day moving average. Now, if as far as trading, we need to wait until AMD starts moving back higher and starts moving back up again, because I don't want us to get into trades with AMD moving the way that it's moving right now. What we need to do is we need to be adding shares to our long-term positions at this level, because AMD won't stay down this low. It won't stay on this low. So this is one of those ones that we need to take advantage of in terms of a long-term opportunity. Let's look at XLK. XLK, this is pure technology. This is all the stocks in the this is all the technology stocks in the S&P 500. We're hovering around a support level right now. We're hovering around a support level, but again, this is another consistent situation that we've got going on here. We've got a gap, right? And I keep talking about these gaps because gaps can be filled, right? They can be filled. A lot of people say the gaps must be filled, right? They can be filled. They must be filled, whatever you want to call it. If XLK breaks below this area, we're talking about 199 on XLK. Now, if XLK were to come down to this, again, consistency, what I'm saying, another area to go long, another area to take advantage of the opportunities that the discounts that the market has been giving us, right? We take everything into consideration. We see what the Fed's got going on. We see how earnings for Q1 actually, came out. How did they do? Right? We take all that stuff into consideration, and we find opportunities to get into the market for the long term and the short term for us to take advantage and for us to make money, right? That's really what we got to do. That's really how we got to trade, right? So let's talk a little bit more. Eli Lilly. Eli Lilly here. This is a healthcare stock. Eli Lilly has had a strong year. Very, very strong year. But again, in an uptrend, hovering around that 50-day moving average. Eli Lilly has a small gap right here that it could fill. I really don't see it coming down that low. That would kind of at that point indicate a reversal of trend. But any type of area where we can see Eli Lilly coming down to maybe a 734 or something like that, we need to look for opportunities to get into this name because this is a very, very good one. Um, let's see, IWM, the small caps. I think IWM is going to give us another opportunity to get in here. And the reason why is because, IWM is very, very, very volatile and it's very, very sensitive to interest rates. And so, you know, when we get to the point to where the Fed actually cuts those rates, IWM is going to go insane. It's going to go out of the park. But you're going to have to stomach a lot of volatility and stomach a lot of pain until we get to that point to where the Fed decides where they're going to raise those interest rates. Now, from a technical perspective, it still looks good. It's still in an uptrend. We still got that 50-day over that 100, that 100 over that 200. We still got that. So that's something we need to pay attention to, but opportunities to trade this one and go longer are going to be good. Now, let's go to a couple of stocks that are not in uptrends. Apple. Apple is not in an uptrend at all, guys. It is not in an uptrend. However, this is still a very good stock, and we need to be buying it long term. Now, do not trade the stock right now. Do not trade this stock right now. And the reason why is because we have a death cross. What is a death cross? A death cross is when the 200-day moving average crosses above the 50-day moving average. That indicates a death cross, and that indicates that the stock is in a downtrend. So we should not be trading this stock, but I still believe in this stock long term. So long term investing in this stock is something that we should definitely do because it will not stay down here for this long because we are approaching some key levels of support. But in terms of trading right now, that's not something that we need to do. We need to be patient and we need to wait a little bit on it. Here's another one that we need to look at. Tesla. Tesla is another stock again that is not getting a whole lot of love. However, do not sleep on this name. This name is going to have a great, great recovery once it happens. But again, it's a situation to where we have another death cross, right? A death cross to where that 200 days is above that 50-day, and we just don't need to be trading it right now. It looks like we've got a double bottom right here. We got a double bottom right here around 160. It seems like what we have, but the downtrend that we've had on this stock, we can't assume that that's going to hold. We have to wait. We have to get confirmation. We could come up to this 50-day moving average and reject it. It's a possibility and continue to move down and hover down to this 152.37 level, which is a possibility. But again, I believe that we should be buying shares of it long term because we're going to have an opportunity for the stock to move around. It's just do not trade it. Now, I talked about that death cross. Let's on the other side, let's talk about that golden cross. That golden cross is when the 50-day moving average crosses above the 200-day. Now that's a golden cross. That's a golden cross. That's an area where we need to really be looking for areas to buy, really go long and really take advantage because at that point, now the trend is now reversing and we need to pay attention to areas that we can go long. And so those are all the stocks I wanted to get into tonight. That's all the information I wanted to get into tonight. I wanted to let y'all know that the stock market is concerned about inflation. Yeah, the stock market is concerned about inflation, and we just need to take heed of the information and just look at all the information that's out there and pay attention out there. Understand that there are going to be opportunities for us to take advantage, but we have to be diligent. We have to stay tapped in and make sure that we are following the charts, following earnings, following everything that we need to follow to take advantage of what is going on in this market. All right. So again, I appreciate you all for tapping into another episode of the Trade for Yourself podcast. Please like this, please subscribe. Make sure you hit that notification bell so you can be in the know every single time I drop an episode. As always, remember, y'all, do not pay for it. Trade for it. I'm going to tap in with y'all in the next episode.